Thank you. Okay, so the horizontal analysis from year to year, as you've seen the public's financial statements, the sales are going up, which is good. The profit margin going up, which is good. The top to bottom is the vertical analysis. We talked about those briefly. The third type of analysis is using ratios, and that's what Professor Prescott was presenting initially, the three different types of ratios: liquidity, profitability, and solvency. So when you look at a company, you look at these three different types of ratios: liquidity, profitability, and solvency. And we're going to look at what they mean, what they measure, and how we calculate that, and what does that tell us about the company. So these three financial statements I asked you to print, right? I emailed you. You have a printout of these income statements, a balance sheet, and the statement of cash flow, the three statements. You have a printout? Okay. So let's go to the first one. We have the liquidity ratio, which is the measurement of short-term ability of the company to pay its maturing obligations, meaning how quickly or how easily can the company pay its short-term debt, its short-term obligations, right? Its current liabilities, for example. So here, the first ratio is current ratio. The current ratio is calculated by dividing the current assets with the current liabilities. So if we go here, if we take the number from 2011, right, using that formula, if we go take the 2011 number and 2010, right, and we put these, we calculate these numbers, we see the first one, the current asset is how much in this company? Yes, current assets. 2017, what is the current liabilities? Right. This is 67.1% or 0.67. That is where this number is coming from. You see that 0.67, right? The 0.67. This is the same as 67.19% or 67%, right? What does that mean? It means the current assets the company has can pay 67% of its current liabilities. Are you following? Because you see the current liability number is higher, right? The current liability number is larger than the current assets. Are you following? Right? So the company, it cannot pay all of its current liabilities with its current assets. Now let's compare that number from 2011 with another company in the same industry, which is General Mills, right? You see General Mills, what is the current ratio of General Mills? 1, which means what? What does that tell us? What is the current liability and current asset? They're equal. The current liabilities equal the current assets, right? When I divide the current assets with the current liability, 1,000 divided by 1,000 would be 1. 5,000 divided by 5,000 would be 1. 10,000 divided by 10,000 would be 1. Which is better? Chicago Cereals or General Mills? General Mills. They are more, we call it liquid, right? This is liquidity ratio, meaning they are able to pay their short-term liabilities easier than the Chicago series. Are you following? Now let's take a look at the industry average. What is the industry average? The industry number says what? 1.2. What does that mean? When I say industry is 1.2, what does that tell you? Which number is better? Which number is higher? The current assets or the current liabilities in the industry? Current assets. That means the current assets are more than the current liabilities by 20%. The current assets are 20% more, right? 0.2 means they have 120 in current assets and 100 in current liabilities, right? That means even after they pay all their current liabilities, they will have 20% of the current assets left, right? So both of these companies are worse than the other companies in the industry, the average in the industry. You follow? So this is what this number is telling us, right? So liquidity means, so let's just take a simple example. Let's say you have only one current asset, cash, right? You have $100 in cash, and you have only one current liabilities, which is accounts payable, right? So you have $100 in cash, and you have $200 in payable, right? That means you can only pay half of the current liability, 50%. You only have 50% of the money to pay what you have to pay, and you have to pay current assets, current liabilities very shortly. You have to pay this within a few months, usually many times within 1 month, right? So having this, right? Having this number less than 1 shows you that the company does not have enough money to pay the suppliers. Down very quickly. Does that make sense? Right? So that's the first ratio. This is we call them liquidity ratio, because whenever you see the word liquid, that means they have enough liquid cash to pay off their debts, right? That's liquidity. Okay. Then we have the next number, accounts receivable turnover. The way it's calculated is net credit sales divided by average net accounts receivable, right? Net credit sales divided by average net accounts receivable. Now, the problem here is the financial statements that they provided us don't have credit sales separately before. What is credit sales? You have two types of sales: cash sales and credit sales. Cash sales are those where the customer pays you cash, they get the item. Credit sales are those when the customer gets the item, you ship it to them, and they will pay later. You only have accounts receivable when you have credit sales. So here, what we are going to do, the way we are going to calculate this is we're going to calculate the whole sales, all of the sales, right? Not just credit sales. So tell me the sales of 2011. The first line on the income statement in 2011. 11,776 divided by average net accounts receivable. Average net accounts receivable is the accounts receivable over a period of months, right? So we take the average of the accounts receivable at the end of every month. We don't have that number, right? So what we are going to use is the accounts receivable at the end. So what is the accounts receivable at the end? 1,026, 1026. This gives us something very close, right? If you calculate this, this will come out to be 11.5. This will come to 11.5. Okay? So Fatima, are you following? This will come out to be 11.5. What does the number show on the slide? 11.9, right? 11.9. What does this number show us? This number shows us that during 2011, their accounts receivable collection was 11.5 times. If you have 12 months and you sell 12 times, the perfect situation is you collect 12 times. You follow? So you come to me every month, right? You come to me every month and I sell you something and you pay me later, right? So if you buy from me 12 times and you pay me 12 times, then my number here will be 12. Perfect situation, you follow, right? So they have some customers that are not paying 12 times. They are behind. So they may have paid 11 times or 10 times. When they take the average collection is 11.9 times, meaning there are some customers that are behind. They're not able to collect from them on time. Are you following? Right? So let's compare that. The industry average is 11.2, right? And General Mills is 12.4. 12.4. How can you collect more than what you have sold? Because you did not collect enough in the previous year. So you average this out. You follow, right? So in 2010, Chicago series is 12, which is perfect. You follow, right? Which is perfect. And everything they sold, they collected. You follow, right? So understand why is this number important. If you sell and your customers don't pay, right? You don't have the cash to do business with. If your customers pay, only then can you operate. So the higher this number is, the better off you are, right? The more liquid you are, the more cash you have, the more your customers pay, the better off you are. Anybody here own a rental property? Do you have any experience with renting a property, rental property, right? So, rather than you know, some people who rent, they don't pay the rent on time. They fall behind, right? This is a big headache for the landlord because the landlord has bills that they have to pay. So the person renting the house won't pay the rent on time, right? And if you, especially if you deal with them personally, right? If it is not dealt with commercially, then it becomes difficult because they can make a request to you and you cannot turn it down, right? As an individual to an individual, right? So collection is very important. If you're not able to collect, you cannot operate your business. Okay. The next ratio. Yes. So this one it does not include cash. That is right. That does not include cash on the spot. So the two types of sales, the customer buys from you and gives you cash. So this is credit sales, debit cash. Accounts receivable is not involved. So those type of sales is not included in the accounts receivable calculation because there is no accounts receivable from those sales. Only those sales, when you credit sales and you debit accounts receivable, only those sales are included in this calculation because that's where the collection is involved. Cash sales, there is no later collection involved. You follow? Cash sales, you immediately get the cash. There is no account receivable. There's nothing to get cash. See?
When you have the credit sales for the general bills, which is above industry average. So over here we have the ratio of the previous year and this year. Maybe we collected a large amount for the previous year, of course, but we could not collect perhaps a large amount for the current year. So this 12.4, I think this is not territory. What I mean is information over here is a lot for the previous year and maybe less for the current year.
Right. So I see this is not a complete picture of anything. This is just looking at a couple of numbers and trying to understand. If you want to really compare Chicago with General Mills, you have to look at 5 years of this company and 5 years of the other company to get the true picture of it. This is not complete information. So what you're saying is absolutely right. Understand, this number cannot be more than 12 unless you have a number less than 12. So nobody goes to Lulu and gives them 10,000 reals saying, I will provide for you later, just keep them. It's more than 12, means they have less than 12 people. Right? You follow? Okay. The next one is inventory turnover. Here we have cost of goods sold divided by average inventory. Now, cost of goods sold number. Tell me the cost of goods sold of 2011. Cost of goods sold. 6,597. Everybody see where this number is coming from? I want you to see where this number is coming from your financial statement so that you can do this calculation. Do you see it, Maria? I want you to see this number. Formula A is cost of goods sold divided by average inventory. So the first number is cost of goods sold for 2011, 6,597. Where does this number come from? You see it? You see, everybody see? The bottom number says average inventory. We don't have average inventory number. Average inventory would be you have to have the inventory at the end of several months and you take the average. So tell me the inventory number at the end. 954. Now, if you calculate this, what does it come up? Calculate this number, 6,500 divided by 924. What do you get? 7 point? Round it to two numbers. 7.1? 7.14. So you see 7.14 and 7.5. So you can guess the average inventory is not way far from this number. So they have similar amount of inventory at the end of every period. You follow what I'm saying? Right? Even if you take that number and you calculate it, this number does not come out to be significantly different. So what does this mean? 7.5, what does this number tell us? This number tells us that they buy the inventory from the money that they get, they buy again, and then they sell. From the money that they get, they buy again, and they sell. They are able to do this 7.5 times every year. You follow? So they are able to buy and sell. At the end, they will have some inventory left, right? So on an average, right, somewhere close to 2 months it takes them, right? It would be, if it was 6, that means every 2 months they get rid of the inventory. They sell 6 times, right? 7.5 is they're better than 6. It's less than 2 months, but they're able to buy and sell the inventory 7.5 times in a given year, right? So, do you want to do more or do you want to do less? Do you want to sell your inventory more often or less often? More. So, let's take a look at the general deals, right? Chicago is better than that, yes? Chicago is better than the industry average as well. So the industry average in general is close, very close to 6 times, which means every 2 months they are selling their inventory. Are you following? Right? Every 2 months they're selling. Right? So our company is better. Are you following? Okay? So you follow? The more often you can sell, the more often you can get your money back, right? In other words, if you buy the inventory, it sits on the shelf, that is your cash stuck on the shelf, right? So the more you can sell, the more liquid your money is. If you're getting the money back very, very quickly, the more often you can sell. So there are many liquidity ratios and so forth, but I did not want to go into too many. I just want to focus on two or three, but you understand the concept. The concept of liquidity is it tells you how often you get your cash, how much cash you have to serve your current liabilities, right? So the more inventory you can sell, right, the quickly you can pay your suppliers. So for example, let's say I have a business and the suppliers give me time, 7 days time to pay them. So if I buy the inventory today, the suppliers give me 7 days to pay them. Right? So they will send me the items, shipping the goods to my business. I have the inventory items. I have to pay them in 7 days. I can sell my inventory in 3 days. I get it, I sell it in 3 days. You follow, right? That means I practically don't need any money from my pocket to do this business. You follow? I buy, I sell in 3 days, I have the cash. Now I have more current assets than I have current liabilities because I buy for 7 and I sell for 10. So I don't have to even sell that, right? And the other 3, I can keep. I don't have to buy inventory because I will order. I will sell before I have to pay them. You follow? I can put that 3 in my pocket. You follow what I'm saying? I can do whatever I like with it. So the faster I can sell my inventory, the less cash I need from my pocket to do the business. Does it make sense? Right? So this is very important. The more often you can sell, if it is 24, let's say, right? You sell twice every month. If it is 12, that means you're selling the inventory every month. If it's 24, then you're selling every 15 days. Super. Because most people give you 1 month to pay. Right? Does it make sense? Okay. Then we have the second set of ratios, which is called the solvency ratios. The solvency ratio is something that tells you your ability to pay long-term debt, right? The loan that you have borrowed from the bank. So the first one is debt to asset ratio, which is calculated by taking the total liabilities dividing the total assets. So let's do that for 2011, right? Since we're doing 2011, this is 2011 numbers. What is the total liabilities for 2011? Total liabilities. Add the short term with the long term. Add the short term with the long term. 4,044 plus 4,827. 8,871, that's what I have. Divided by total assets, which is? Everybody agree? I want you to see where these numbers are coming from and not just follow me here. Look at the financial statements to see where these numbers are coming from, right? Everybody sees the number, you're able to see. Okay, so what is this? What is the percentage then? How much is it? Right, it's 77.84, right? 0.7784, yes? 77.84, it's rounded in the slide, which is 78%, right? What does it tell us? Which is higher? Is the liabilities more or the assets more? The assets are more. That means the liabilities are 78% of the assets, right? The liabilities are 78% of the assets. Compare that with general means, 52%, which means what? Their liabilities are almost half of their assets, right? Same, the industry average is also the same. Liabilities are half, right, of their assets. Which is better? The less liability is better. Now, again, there is a philosophical discussion about this. Because some businesses or some executives or some investors, they think that the more business you can do with other people's money, they call it OPM, other people's money. The more business you can do with other people's money, the better off you are, right? But on the other hand, it makes you very, very, the situation becomes very tight. You follow? Because if there is an economic downturn or there is a problem with your business, sales go down, etc., then you have the risk of going out of business even, because most liabilities have some covenant, some assets attached to them. You follow? So sometimes you buy equipment for the business, and there is a loan against the equipment, but the bank has in the contract that if you're not able to pay, they will take the equipment and sell it, right? Whereas if you own the equipment, even if it is a little bit less, you get a little bit less profit, you keep the equipment, right? So this is a tight situation. This is debt to asset ratio. This is the better your ratios are, the more solvent you are. The more solvent you are. Follow. The more self-sufficient you are. If you don't have any liabilities with all assets, some people will say this is foolish because you can borrow, right? Again, this is a philosophical discussion. Me personally, I were to advise, when I did advise myself, I always advise them to lower and get rid of the debt, because you can now become solvent, right? You don't have to worry about paying that debt. There are two things that most businesses have to pay even when the sales are down. Those two things are the rent, if they're renting a facility, and the other one is the loan, if they have borrowed money, right? If your sales are low, then you can buy less inventory. You can lower that cost. If your sales are low, instead of having 3 people working for you, you can have 2 people working for you. You can adjust that anytime you like. You follow, right? You can adjust that. But if you borrow money and your sales are low, very difficult to adjust. You rented a big space and your sales are low, very difficult to adjust. So if you have one of these things not present, which is the debt service, which is the loan, then you have one less headache too. You're more solvent. Does this make sense? Okay. And again, this is my philosophy, right? I'm telling you, and I'm telling you also the other philosophy there that, OPM, use other people's money. Okay. The other solvency ratio is cash debt coverage. So here we have net cash provided by the operating activities divided by average total liabilities. So net cash provided by the operating activities. For this, you have to go to the statement of cash flows. So go to the statement of cash flows, and you will find there is a number that says net cash provided by operating activities for 2011. 1,500. So Muhammad, you're able to see that number? Adil, I want you to see that number, because when I need you to calculate this, you have to go to that number, right? So 1,503. And then the bottom number is average total liabilities. We don't have any average, so just take the total liabilities. Go to the total liabilities. How much?
8,870.
Come on. Total liabilities. Oh, same number, yeah. 8,871. Okay, so what is the percentage now? What is the number now? 0.117. So you can see the average liability is very close to the current total liability, right? Okay. So what does this tell us? What does this tell us? 0.17. We can only pay 17% of the total liabilities with the cash that we have from operations. Okay? Again, this total liabilities is not due right now. Maybe there is a 5-year loan, right? You have to pay that loan back in 5 years, right? So the operating cash is only able to pay 70% total liabilities at any given point in time. And as you can imagine, the higher this number is, the more solvent you are, the more operating cash you have, right? There is a saying in the industry that is cash is king, right? Cash is king. If you have cash, you can do anything with it, right? Whereas if it is invested in any other asset, you're limited until you sell it, right? You're limited in what you can do with it. So the more operating cash you have, the better off you are. And we used to say that sales cure all evil. So if you have high sales and your management is not that great, right? You still come out looking good. You follow? And I always tell the story of one of my clients. We had, Quiznos stores. I don't know if you have any Quiznos in Nova. It's like a Subway sandwich shop, right? It's a little bit high-end Quiznos. They have Subway sandwiches, and an average store in the U.S. sells $40,000 per month. $40,000 sales, top line, right? I had a client, she opened a Quiznos shop in Las Vegas Airport. Las Vegas Airport. And her savings was $25,000 per week. Which is $100,000 per month. Her operation was a disaster, but she made a lot of money. You follow, right? The $40,000 store makes about $8,000 profit before taxes every month. That is the average, normal industry number. She did maybe 25,000 in profit, right? You follow, right? But she should do more. Anyhow, so she felt, I am the entrepreneur and so forth. So she opened another shop, another location outside the airport. Now the reality strikes. She now has a store with $40,000 in sales and a $5,000 in loss every month. And she's having to put money from the airport store into this store. So now whatever profit she was having, so she then called me and said, what do I do? I said, okay, now we can talk about your operations, because your operations is not that good. There's a lot of waste, there's a lot of mismanagement. You can make money from this store by itself, and you can make more money from that other store where things are not good. So the bottom point is, sometimes if you have high sales, it hides the bad operations, right? You look better than what you actually are because of high sales, right? Okay. The next, so this, I'm telling you this because of the operating cash. Operating cash, cash from operating activities comes if you have high sales, right? Okay. Then the next set of slides, and again, there are many solvency ratios, okay? There are many solvency ratios, but I'm just keeping it limited so that we can focus and we can learn what they mean. They mean your ability to pay the debt, your ability to pay the loan, okay? The last one is profitability ratio, and we have two of them here. One is the profit margin. Now this profit margin, right? It's calculated by taking the net income divided by sales. So tell me what is the net income for 2011? Net income. 1,103. Okay. I want Ms. Fatima to tell me what is the net sales of 2011?
11,726.
Very good. So you see where the numbers come from. 11,776. Now, right, very good. Ms. Mike, do this calculation for us. Tell me what is the profit percentage? Profit margin percentage. Zero point zero nine what? 0.09, and after that? Okay, so 0.09, that is 9.37%, right? So 9.37%, which is very close to 9.4%, right? They are showing 9.4, we have 9.37, no big deal. This is how much profit you have after all operating expenses. So let's say, for the ease of calculation, let's say this number is 10%, right? Let's say this number is 10%. Now, you go to a sandwich shop, you go to a restaurant and you buy a shawarma for 10 riyals, right? 10 riyals, which is the sales, price, 10 riyals. If the gross profit, not gross profit, sorry, the profit margin is 10%, that means for every sandwich they sell, every shawarma they sell, what is the profit? How much, what is the amount of money? 1 riyal, not 1%, 1 riyal, right? So they sell a sandwich for 10 riyals, right? When they're getting the 10 riyals from the customer, right? That is sales, that is not profit. Because from this 10 riyals, they have to pay 9 riyals for running the restaurant. So for every sandwich, they're only getting the follow, right? So this is the difference between sales and profit. This is something that many business owners don't understand. The difference between sales and profit. Profit is after you pay everybody, not what your customers pay you. What your customers pay you is sales. 90% of that you have to give away to somebody else, right? So, say that again. Cost. Right, so expenses, right? So you have to pay for the expenses. So this number, now let's compare that with the industry and the general means. Very close, right? 9.4, 9.1, 8.8, very close. Unlike what we saw for publics, right? It was 1.5 and there was 8 point something, right? Very, very high, very unusual, right? So when you see that, then you have to dig into why is the difference so much, right? So this is where the consulting expertise comes in, that when I used to look at my clients' financial statements and I have, instead of 10%, the gross profit is 5%, then you have to go back and see what is the, why do they not have as high as the industry average, and then you will find problems in the operations. You find that there is food waste, or you find that there is unnecessary labor. They have more people than they should have, and they're having to pay them, and they don't have enough savings to cover it, right? It's a sad reality of life, but you have to give them advice to reduce their labor force, if that's the case, right? So this is what happens, right? This is a lot of this happened during this pandemic where companies did not have enough sales to support their labor, so they had to let them go to keep their companies from going into loss. Uh-oh.